Hello everybody, and thank you for watching this recording. In this recording, we are going to go over a worksheet. This is the income statement worksheet, and this is gonna be a bit of a tutorial for you about how to complete it. Okay, on the left-hand side, I have included the income statement, and on the right-hand side, we have the costing triangle right here. Okay. Again, I don't have a stylus just yet, so be patient with my drawing. Okay, so where to start with this is get rid of. We want to start at the top. We have to be able to calculate each of the blue highlighted cells. So we would start off with our food sales. We know our total sales and the percentage of our total sales that is our food sales, so we could multiply the two to solve for our food sales. Now, this is where the costing triangle comes in handy again, is that we know the sales and the percentage of the sales, so we multiply the two together to get our respective food sales. So we take 630,000 and multiply it by 0.71 or 71%. And it gives us a food sales of $447,378.81. Okay, again, just multiplying the two, total sales multiplied by the percentage of sales, and that'll give us our dollar sales for food. In a very similar way, we do the same thing with our beverage sales. We take our total sales and multiply it by the percentage of total sales that is our beverage. So we take our total sales and multiply by 0.29 or 29%, and we get a beverage sales of $182,732.19. Okay. Now, moving on down the worksheet, we want to now look at our cost of sales and our gross profit. We know that our food cost was 29% of our food sales. So again, using the costing triangle, we know the sales and we know the cost percentage, so we multiply the two together to get our dollar cost. So we just do that, or we do just that. Our food sales multiplied by 29%, and we get a food cost of $129,739.85. We do something similar with our total beverage, our beverage cost, except we would multiply the cost percentage by beverage sales. Again, not total sales. So we do that. Our beverage sales multiplied by the percentage, in this case it's 27%. Our beverage cost was $49,337.69. Okay, now we want to calculate our total cost of sales, and we do that just by adding our beverage cost and our food cost together. So we take our dollar food cost and our beverage cost, and we add them together to get a total cost of sales of $179,077.55. We can also express this as a percentage of sales. So we would take the dollar cost and divide it by total sales. This is where we have to pay attention, is our food cost and our beverage cost. When we're calculating the percentage, we're dividing by our food sales and beverage sales, not total sales. Okay. Now we can calculate our gross profit, which is our total sales minus our total cost of sales. So we take our total sales minus our total cost of sales, and we get a gross profit on sales of $451,033.45. Now, at this point, I'm going to note that our gross profit on sales, our income before occupancy costs, and then our net profit before income tax, those are all just running profit numbers. And we do that just to be able to measure efficiency and see which what proportion of our cost is being taken up in different cost categories. For instance, our cost of sales is a category, our controllable expenses, other controllables, and then interest and depreciation. Okay. Going back to our gross profit on sales, we also want to express this as a percentage of sales. So we take our gross profit and divide it by total sales. Excuse me. This is where the efficiency comes into play, is these percentages here. We'd be able to compare our food cost percentage and our beverage cost percentage to those of previous periods and see if, or even our standard costs, to see if we've improved on our efficiency. So whether or not we are wasting less food or beverage, or we're in fact wasting more. That would be categorized by having a higher cost percentage than a previous period. We can also use our gross profit on sales as a percentage to give insights towards the profitability as well as the efficiency. For instance, we can say at this point that 71% of our sales is being directed into our gross profit, which is a good thing, which means around 29.5-ish% has gone towards covering our variable costs. So that's a pretty good thing. It's better to have a higher percentage than a lower percentage, of course. And we can measure the efficiency, again, just by comparing to previous periods. Okay. Next, we move down to the controllable category, or the first portion of the controllables. Our salaries and wages were $213,064. We want to calculate that as a percentage of sales, so we take, again, the dollar cost divided by our total sales, and our salaries and wages were 33.81% of our sales. Is this good? Is this bad? It's hard to tell. Again, the only way we get an idea of efficiency of an operation is by comparing it to a previous period. So for instance, if last period our salaries and wages were 31% and now it's gone up to 33.8, you could say that maybe we used a little bit more labor than we should have. Although, what happens if maybe you hired on an additional salaried body, like a salaried manager or chef or whatever the case, you could at least justify the increase in labor to that. The idea here is when we're looking at these numbers, it's always important to kind of ask why the numbers have changed in comparison to previous periods. Because if you don't know, might make you look a little silly when people start asking some questions. And people will ask questions. If you're a general manager or a chef of a restaurant, and there's an owner, like if you're not the owner of the restaurant, they're going to want to know why the numbers look the way they do. And these numbers tell a story that some people get and some people don't. So when you can't read these numbers, as a manager or chef, it makes you look a little silly. You have to have a justification as to why they are what they are. Because especially with the controllable expenses, because those are items that you can control directly. Okay. Next, we have our employee benefits. Again, as a percentage, we just take the dollar cost and divide it by the sales. Looks funny. I'm just going to quickly format the cell. It is in percentage. What is doing that? Never mind. I'm going to leave it like that. Okay, now moving on to other controllable expenses. We want to calculate the percentage of sales that is our repair and administration. So we take the dollar cost and divide it by sales. You might be wondering, what is repair and administration? Administration would be, say, like a bookkeeper that you pay on the side to get all your invoices paid and things like that. Repairs would be repairs to the building, repairs to equipment, things like that. This number, obviously, when you first open up a restaurant or or whatever is going to be relatively low because everything is brand new. The older your building gets, the higher that number is. For instance, one of the restaurants I worked at, two of our heat exchangers on the roof exploded, and we had to replace both of them, and each one was $33,000. For a restaurant that I was already at break-even sales levels, this was very difficult to do. So that would have meant an additional investment on the part of the owner, or in this case, it was Kara, so not really an owner, but that's just extra money that you kind of have to dump into the business. So it's always good to keep that number low if possible. So our total controllables, which is everything added up, and just let me make sure that it is indeed everything added up. I think I had an issue with this last time, to be 100% honest with you. Oops. 13 plus 15. There we go. Oh, it was different. We want to show this as a percentage of sales. So again, the dollar cost divided by the sales. So we can say that our total controllable expenses were 43.53% of our total sales. Next, we want to calculate our income before occupancy costs. Again, just like our gross profit, this is a running profit number that we would have on the income statement. How we calculate this is by taking our gross profit, or our last running total profit, and subtract the total controllable expenses. So our income before occupancy costs were $176,730.45. As a percentage of sales, we'll take item divided by sales, and we get 28.05%. Okay. Moving on to the next cost category is interest and depreciation. We want to calculate these each as a percentage of sales. So we take the cost item divided by total sales. We're just doing that with each one all the way down. The cost item divided by total sales. Okay, so that's just dividing by total sales. Okay, so not so bad. Occupancy costs would be your rent, okay, and any other costs associated with the fixtures within the building. Your interest expense would be paying interest on any loans that you have with the restaurants from the bank, lenders, whatever the case. And depreciation, I'm not expecting everyone to know exactly what depreciation is, although it's the allocation of cost of an asset, of a depreciated asset over the course of its useful life. So don't really need to know exactly what depreciation here is in this case. You just need to know that it is a cost item and that we would subtract it in order to calculate our net profit. So now finally at the bottom, calculating our net profit before income tax, we take our income before occupancy costs, and then we would just subtract each one of our occupancy costs. So we're just subtracting them from our income before occupancy costs. So our net profit before income tax was $49,514.45. As a percentage of sales, we just take the item again and then divide it by sales, like so. So it was 7.86%. In terms of whether this is good or bad, it depends. It depends on a lot of things. For instance, if your salary is included in the salaries here, and you are the owner, and you're paying yourself fairly well, like 80 grand, something like that, then this is actually pretty good, because that's not a whole lot of money to live off of as an owner. Assuming this is an income statement for a year. If this was for a month, that's not pretty, but that's pretty good. So it depends on a whole lot of things, to be honest with you. But 7% on sales, that's pretty good. Okay, we'll go over this again in class. I'm not 100% sure whether we have a computer lab or not, so Whether we'll be doing this on paper or Excel is kind of up in the air right now. I'll have to see on the first day of class. Okay? Thank you for watching this recording.